The stock market is currently closed. As of the last closing bell on Friday, December 19, 2025, Denison Mines Corp, trading under the ticker symbol DNN on the NYSEAMERICAN, finished the session at $2.74 USD. This represents a substantial intraday increase of $0.17, or approximately 6.61% on massive trading volume that far exceeded its typical daily averages. While a 6% move might look like standard volatility for a mining company to the casual observer, there is a much deeper tension at play here between market expectations and the operational reality that is starting to surface. Most investors treat Denison as a speculative bet on the fluctuating spot price of uranium, expecting it to simply mirror the movements of larger peers or the broader commodity indices. However, the reality is that Denison is quietly transitioning from a developer into a highly efficient producer with a cost structure that would make even the largest global miners take notice. The immediate catalyst for this recent price action likely stems from the successful completion of the Canadian Nuclear Safety Commission public hearings for the Wheeler River project, which took place earlier this month between December 8th and December 11th. While the market waited with bated breath for any sign of regulatory friction, the reality that emerged was a project nearing the finish line with strong provincial support and a technical design that is essentially 85% engineered already. This gap between the expectation of a long, drawn-out permitting battle and the reality of a project ready for a final investment decision in early 2026 is what is driving this surge in institutional interest. It is no longer just a what-if scenario. The company is sitting on nearly $720 million in cash and uranium holdings, giving them a level of financial independence that is rare for a company of this size. If you are looking at your screen right now through a Fidelity trading platform or tracking your positions on the Robinhood app, you might see this ticker appearing in more most active lists than usual. The volume we saw on Friday, nearly 80 million shares, indicates that large-scale funds are beginning to rotate into names that have clear paths to production rather than just those with theoretical resources in the ground. Many people get their investment help from automated services like Schwab Intelligent Portfolios or various other investing sites, but those systems often lag when a fundamental shift in a specific sector occurs. The expectation for years has been that new uranium supply would take a decade to bring online, yet the reality is that Denison's Phoenix deposit is positioning itself to be one of the lowest cost operations in the world, utilizing in-situ recovery methods that could completely change the margin profile for the entire Athabasca Basin. When we look at the broader landscape of online investing, the focus is often on high-flying tech names like Tesla stock, Apple stock, or Nvidia stock. These are the giants that dominate the headlines and the individual brokerage accounts of millions. But smart investors understand that the massive energy requirements for the data centers powering those tech gains have to come from somewhere, and nuclear energy has moved from a fringe discussion to a central pillar of global energy policy. There's an irony here. The very people buying Nvidia stock to bet on the growth of artificial intelligence are indirectly betting on the success of companies like Denison. Without the carbon-free baseload power provided by nuclear plants, the massive expansion of the digital economy becomes an environmental and logistical impossibility. This creates a fascinating feedback loop where the demand for uranium is being driven by the very technological growth that retail investors are chasing through SoFi Active Investing or Interactive Brokers stock trading. The common narrative you'll hear on most investing sites is that the uranium market is a boom and bust cycle driven by geopolitical tensions in regions like Kazakhstan or Niger. While that is true on the surface, the deeper reality for Denison is its strategic positioning in the Athabasca Basin of Saskatchewan. This region is essentially the Silicon Valley of uranium mining: high-grade ore, stable political environment, and established infrastructure. Just a few days ago, on December 17th, Denison announced the closing of a transaction with Skyharbour Resources that further solidified this dominance. They formed 4 new joint ventures right next to their flagship Wheeler River project. The market expects junior miners to bleed cash through exploration, but the reality is that Denison is acting like a tactical landlord, expanding its footprint and leveraging its technical expertise to control the most prospective ground in the basin. Comment below how many shares of Denison Mines you currently hold and if you are planning to add more at these levels. It is always helpful to see where the community sentiment lies, especially as we see this divergence between the technical charts and the fundamental progress. Many self-investing enthusiasts using SoFi stocks or Fidelity brokerage accounts often ask if they should just stick to broad sector plays like Fidelity ETFs or Fidelity mutual funds. While those are excellent for diversification, they often miss the specific alpha generated by a company hitting operational milestones. For example, Denison recently achieved a major win with its saber mining method at the McLean Lake joint venture. They extracted over 2,000 tons of high-grade ore with an initial operating cash cost of roughly $19 per pound. When the spot price of uranium is hovering in the $75 to $80 range, a $19 production cost creates a profit margin that is simply staggering. This is the reality that is beginning to displace the expectation of Denison as a high-risk explorer. They are proving they can pull metal out of the ground cheaper than almost anyone else on the planet. For those managing their own Fidelity IRAs or using the Fidelity mobile app for long-term planning, the inclusion of a specialized miner like Denison offers a different kind of growth profile. Most retail investors are used to the steady, albeit sometimes volatile, climb of something like Apple stock. But in the mining world, value is often unlocked in step changes. We are currently in the quiet period before the final construction decision for the Phoenix deposit. The expectation is that the company will spend the next year just preparing, but the reality is that they have already committed $44 million to procurement and secured long-term funding through a $345 million convertible note offering. This means they aren't waiting for the market to give them permission to build. They are already moving. If you look at the recent institutional activity on your Interactive Brokers platform, you'll notice that funds like Van Eck and Sprotted have been aggressively increasing their exposure. This isn't just dumb money following a trend. This is a calculated bet on a structural deficit in the uranium market. The world is building more reactors than it is closing, and the secondary supplies that kept prices low for a decade have largely evaporated. This reality is crashing into the market expectation that supply would magically appear to meet demand. It won't. It requires years of permitting and hundreds of millions in capital, which is why a project like Wheeler River is so valuable. It is one of the few projects that is actually close to the finish line. Let's talk about the business model for a moment because it is often misunderstood. Denison isn't just a one-trick pony with Wheeler River. They hold a 22.5% interest in the McLean Lake Mill, which is one of the most technologically advanced uranium processing facilities in the world. This is a critical piece of the puzzle. Even if you find the best ore in the world, if you can't mill it, you can't sell it. By owning a piece of the infrastructure, Denison has a seat at the table that most other small-cap miners can only dream of. They also have interests in the Millennium and Kigavik projects through their 50% ownership of JCU Canada. This diversification is the reality that counters the expectation of Denison being a high-concentration risk play. Looking ahead to 2026, the potential catalysts are lining up like a series of falling dominoes. We have the expected regulatory decision on the environmental assessment in early 2026, followed by the potential for a final investment decision. If the reality of those approvals meets the growing expectation of a nuclear renaissance, the current price of $2.74 might look like a distant memory. Of course, there are risks. Mining is inherently difficult, and any delays in construction or cost overruns could dampen the mood. But when you compare Denison's balance sheet to its peers on any of the popular investing sites, the resilience is clear. They have the cash to weather a storm and the high-grade assets to profit in a sunshine scenario. For the individual investor using a Robinhood stock trading account or managing an Interactive Brokers account, the key is to look past the daily noise of the 6% swings. This stock has moved from $1.08 to nearly $3 in a year, and that move wasn't just a fluke. It was the market slowly waking up to the reality that the transition to carbon-free energy is non-negotiable, and that Denison is one of the few companies with a clear, funded path to providing the necessary fuel. Whether you were doing your own online investing or utilizing a SoFi robo-advisor, understanding the supply-demand gap in the nuclear sector is paramount. As we summarize the situation, the contrast between expectation and reality is the defining feature of the Denison Mines story.